I mean, I feel like if someone says that passive income is passive from day one, that they're lying to you or they've never done it.
If you're talking about real estate in terms of like buying a house, renovating it, renting it, holding it, and things like that, yeah, absolutely. There's really nothing passive about that.
Nothing, because before it's passive, it's stress, it's risk, it's, you're crunching numbers, like you're out of cash, you're late nights when everyone else is sleeping.
People even think like, oh, well, that's because you don't have a property manager, you're self-managing. Like we have properties that we've never even been to, we've never even seen, and we have property managers, and they still stress us out. There's still decisions we have to make. There's still, renovations that we've got to, figure out budgets on, and it's still not passive.
So is that not us not having the right property manager, do we think? Or, I mean, personally, I think no. I think there's going to be decisions and things that happen regardless that we have to, have our hands in. But then it's also finding the right property manager too, because we've had experience that we've talked about in the past of not having the right property manager. Like it's just there is no part of it that is passive.
Yeah, property manager is only one part of it though. You've also, like the properties that we buy are value add properties. So, the apartment building we bought was a value add play. So we're looking to build equity. So there's a lot more that goes into a project like that. So if you're managing a project and the stress of these projects, I mean, we know flippers that have been just stressed out on projects that they did, and the carrying costs are huge, and then the market turned and it's not selling and it's sitting on the market, and they're stressed out because they're making payments each month on these large construction loans.
I mean, we're not flippers, but we're feeling the stress of that. So welcome back to the Broke Millionaires, where we document our daily struggles in building wealth while raising a young family. Join us as we talk creative wealth building for everyday people and couples that are struggling in a down economy. I'm Lauryn.
And I'm Joshua Masari, and we'll be your hosts.
Welcome back.
Casual Tuesday.
Gonna say Friday, but it's definitely not Friday.
Definitely not.
Kind of wish it was. We are casual today.
Yeah.
Sometimes we've been dressing up lately, but it's kind of nice to get back into.
Well, the setup for me is like running around, and it's easier to, I don't know. I'm still trying to get it all figured out.
Yeah. I like dressing up. It's the only time I get out of my mom uniform of workout clothes, but it's fine.
You look good today. You got the
Don't I look good every day? What do you?
Yes.
Come on.
Yes, absolutely.
Good answer.
What I was thinking.
Thank you.
You look great.
Thank you. I appreciate it.
Okay.
You don't look so bad.
Moving along before I get myself in trouble.
What updates do we have?
Oh, it seems like there's always fun updates that we got to talk about. So I feel like this week we have our three main properties. We've got something pretty major going on this month that has to happen in the next couple of weeks. So it's a little bit of a crazy time right now. The first one, probably the most pressing, well, they're all pressing, but the biggest dollar amount thing that we're trying to figure out is the construction loan on the project that we finished up this last summer. We talk about that a lot in the past episodes. We finished that about 6 months ago, and it's been renting as a midterm rental since then. It has a great occupancy rate. It's been a great rental. The renovation on that, beautiful home in a great neighborhood. So that one couldn't have come out better. We're very pleased with the way that one came out. However, now it's time now that it's completed, we now have this construction loan. The reason we got a construction loan is because when it was all demolished and half tore apart, the banks you can't get a normal loan on that. You've got to do a construction loan, which is, we did a private loan on that, and it's a much higher carrying cost. It's a higher risk for the lender, but it's a much higher carrying cost for us. We're paying 14% on that. So we need to get rid of that loan. So right now we're looking at options to be able to take that loan out and refinance it. The original plan was to get it renting and then just do a DSCR loan and refinance the first and this loan into one. The thing that we're running into, lots of things we're running into, but one of the big ones is that the loan on the first position is at 6% interest only for 5 years. We still have 3 years left on that. So we don't actually have to refinance that one, but it's the second position that we've got to get figured out. But if we refinance everything right now, rates are still higher than 6%. So we're going to be paying, our interest is going to go up on the first, and that's a much larger chunk. So it's just kind of like, I don't really want to refinance the better loan. It doesn't make a lot of sense, but there's not a lot of options. So we're trying to get a little more creative now, looking at some more creative loan options that will refinance that second position, whether it's a HELOC or it's just a bridge loan to get us a few more years. We're also exploring doing a home equity agreement, which we've done on some of our other properties before. And basically, a home equity agreement is where you sell off a portion of the equity. Basically, you own your home 100%. Say you sell off 20% of the home, and an investor or a bank will give you a lump sum of cash to own that 20% of your property. And usually it has a little bit of an additional rider on it or bonus on it, I guess. I don't know what you would call it, but they get an extra couple percent as a hedge in case the value for some reason drops. Like we're in, a market that goes backwards. They've got a little bit of extra, so that way they're hedging in case the value drops a little bit. But they're also getting instant equity. So the day that they sign the paper, they've got that extra couple percent right on the front end. So if you were to sell or refinance the next day, they're also getting their money back. So it kind of guarantees some sort of profit if you exit early. So that's what we're looking at. But we're having to get a little more creative as usual, because the larger banks that do these type of loans, they're not really loans, they're investments, but they only do them for like 10 or 20 years. And they won't do a 10-year loan or a 10-year investment when you have an underlying lien that's due in 3 years, because it would have to take them out and then they wouldn't get all that appreciation over 10 years. So that's what we run into with the larger banks that we've tried to do this with. So now we're looking at taking a private investor to do the same type of structure, but doing it on a shorter term. So do something like 3 or 4 years to where it covers the 3-year loan that we have, and then we'll have to refinance everything at that point. But hopefully rates will be a little better at that point, so it makes a little more sense. But at least we're not giving up now and having to pay a higher interest for the next few years.
So for someone who is interested in finding a private investor like that, how would you go about doing that?
Well, it's not easy. It's not something where you just pick up the phone book and call Mr. Private Investor that's first on the list. Doesn't really work that way. There's a lot of people in the industry, but you just kind of have the connections, or there's a lot of brokers that deal with these type of, hard money lenders, private lenders, where it's more, not your conventional bank. So it's more out of the box, and that's designed more for people that are doing flips. We're doing flip and hold or fix and hold, which is a little unusual, not as commonplace, but they still do those type of loans. And these are the type of lenders that do it. So they're getting a higher interest rate. They're getting higher points when they write the loans. They get a higher carrying cost. And so it's not something you want to carry on for several years. So it's something you want to get in, get the property fixed while another bank's not going to finance that property because it's, under renovations. But once the project is completed, then you exit that by refinancing. So we're kind of at that point, we're just trying to figure out what makes the most sense. We just happen to have this first position lien, this loan that's a really good seller finance that we were able to structure. And it just doesn't make sense to give that up and pay more interest for no reason other than that's what we decided to do. So just trying to balance out what makes the most sense. So right now, we're going out and talking to investors, and we're floating this idea because we're actually structuring this ourselves on this property to be able to go to a private investor versus going to a bank and get this kind of in between shorter term that we're looking for to bridge it for us. So what happens is we can pull that money out tax free because it's basically a loan, looks like a loan. You're not selling the property, so you don't pay taxes on that money that comes out, and there's no payment on it. Somebody owns a portion of the property, and they don't own, so they don't get rent income. But they're also not responsible for insurance and taxes. You do it like it's your own property. They just own the equity portion. So when you sell or when you refinance, then that's when they collect on their portion.
Makes sense.
So out of the box as usual, but it's a creative way to, one, help us get this other loan refinanced and figure that out. But also we would have no payment on that. It still accrues because you're just giving up in future equity, but it helps us with the cash flow. So we're not having to pay, higher interest rate on that portion, which we are right now. And it just helps to stabilize the asset, helps you build up your reserves. And when you go to refinance everything into a DSCR, the financial picture just looks a lot stronger to the banks. So that's the idea and the play there. So fun stuff.
Hopefully we'll be able to find someone that is.
Yeah, we'll see. I mean, we've got a lot of avenues that we're looking at, but we'll update you once we figure that one out.
So that's one of the properties. Then we
Yeah.
have our property prior to that we've been talking about, the solar, that whole issue.
Yeah, and a quick recap. It's not that we're getting solar because we want solar. We need a roof because we have this old cedar shake roof. It's actually not even that old. It's only 15 years old. But after the Palisades fires, insurance cut us off and said we're not going to insure cedar shake roofs anymore. And no insurance company will touch it. So we are currently using what's called a non-admitted carrier, meaning they are not admitted into the state of California. Basically just meaning that this insurance company isn't licensed in California or isn't. I'm not really sure what it exactly means. I just know that they're not a California insurance carrier. So it's an out-of-state insurance company that insures it. It's a lot higher risk for them because they're not in California with a bunch of properties to spread out the risk. They're just insuring ours. So if there's a fire, they're responsible for the whole thing and they don't have all these other premiums they're collecting from people to spread out that risk. So that's why it makes it a lot higher. And we went from paying $2,400 a year to over $14,000 a year because of that high risk. So we had to do it. So right now we're getting a solar program or a solar system put on, and part of that is the roof, and it's all kind of financed into the whole package. So we're able to actually lower our expense on our power, or it's probably about the same, maybe a little less, but we're getting a roof out of it. And then over time, it'll probably save us money as rates go up on power. Ours is going to be, it's kind of like a set incremental. So will probably save us more money in the long run as well. And this is a furnished rental. We pay all the utilities. So with solar, there's less concern about people running up the AC bill in the summertime.
Yeah, that'll be helpful for sure.
Be kind of nice. And we just have a set. So it'll be the same monthly payment every single month throughout the year rather than going up in the summer, down, and then up in the winter when the heat's being used. So it'll help kind of just stabilize our cash flow on that as well.
Yeah. And then we've talked a little bit about the current house that we're in, that fun lien. Is that what it was that was on the property?
No.
Not a lien.
No, it was the owner. It was a
yeah.
previous owner from
The title.
30 years ago that didn't sign properly on when they sold it. It was their portion. It was a fractional ownership. They owned a portion of the property, 25%. It was in a trust. And when they signed it over, when the property was sold, they signed as an individual, not as the trustee. So someone flagged it from 35 years ago that was an ineligible signature, and they got put back on title. So title company, our title insurance company, has been fighting this for the last over 2 years now. Going to court on Friday to go and testify that I bought the house not knowing this, and I am the owner, and yada yada. And so hopefully we'll close this out, and by the time this airs, we'll know.
Do we know, is this something that happens often? Like, that feels like such a crazy mistake or like something to miss, that because you didn't purchase the house from them, right? Wasn't it? There was multiple owners
There was
in
like
between
three
them.
other owners. So this goes back, like the chain of command goes back to 4 previous owners before me, and it got missed all the way through and has changed hands as 100% each time. And so it's just one of those fluke things that just got overlooked and missed. And I don't know who went back to the records and went and found this, but somebody at the county had nothing better to do than just start looking at signatures to make sure they were, T's were crossed and I's were dotted. I don't know how someone finds this.
That was going to be my question, is was there any other way that this could have been triggered, or like how do you even find that?
Maybe
it's
some
wild
intern
to
that
me.
was like trying to rack up hours and just was like trying to find stuff. I have no idea how this gets flagged and how this like came about. No clue, but it happened and we're dealing with it.
It's been a headache for the last couple of years. So hopefully we can.
And this is our next big project, and we can't do anything. We can't do any financing on it. We can't, we couldn't sell it if we wanted to right now. We don't own it. So we can't sell it. We can't refinance. We can't pull money out to fund the project that we're trying to do. I mean, we're not even going to start doing anything until we get this cleared because it's not technically our house on paper right now. So it's kind of holding everything up, which is unfortunate, but.
And the person is being completely reasonable and understands, right? It's not like they're trying to fight it.
The person's been dead for like 30 years or 20 years.
The family that's...
Oh, I don't know if they even have made contact with
I thought there was still family. Oh my gosh.
There might be. I have no idea. Nobody knows.
So it's literally just the signature. It's not that there's a person.
Yeah. I mean, there may be. I don't know, but they had to like advertise. Like, it's like so far removed and generations ago that like this person's been like passed away, I don't know, a long time ago. And so it's just one of those things like, it's just like a little technical error, but it's caused a very significant inconvenience for us.
So crazy. Oh my gosh. Well, those are our property updates. Like you said, lots going on all at once and all this month. So hopefully we'll have some positive outcomes for all of the positivity, remember? Some positive outcomes for those in the coming weeks. You also told me, this is off topic now, but you told me about a house you saw for sale for $10,000 in San Diego.
Yes. Yeah. So one of my
What?
buddies, Freddie, actually sent this morning. It was kind of crazy. There's a property in San Diego currently listed right now as of the recording. It's been listed since last summer, and it looks like someone was doing a flip or something because it looks like it's nice, pretty well done, and it's all furnished, and they just haven't been able to sell it for whatever reason, and they kind of kept lowering the price. I think it started like around 1.5 or something, 1.5 million. It was most recently at 1.2 million, and then today or just this week they just slashed the price to 10,000.
So do you think that's a typo and they were supposed to be a million? Like they were.
You would think so, but it says in the very first line of the listing, the price is not a typo.
Oh, okay.
So it's very
What?
intentional. So obviously they're very motivated to sell, and they're just trying to generate some buzz and obviously get it bid back up. They're not going to sell it for 10. What if nobody actually comes to the offer? Like, do they have to sell their advertising at 10,000 if nobody else comes to the
Well,
table?
that was going to be my question. Do we need to make a call to try to buy a house in San Diego for 10 grand right now?
Well,
Like, should we push pause on this recording and go?
Well, you should just not air this until after if that's the case. But that's kind of crazy. What if there's a reason that nobody wants to buy? What if it's like because of the area, there's
like a condemned house or like something.
Or probably not condemned house. What if it's like close to a power plant or something that people like nobody wants to live there? Maybe that's the problem. Like, what if nobody actually gives you an offer that goes over $1 million and you're stuck selling it for the highest
All right,
bidder,
you need
which
to
is
send me the
50,000? Like,
listing.
can you advertise at 10,000, get an offer at say like up to 50,000, and then say no, you don't want to sell it because it's worth more? Like, how does it? There's got to be some sort of liability for advertising it, right?
I mean,
don't
you
know.
can always say no to an offer though, right?
Right,
Well,
but you can't if you have no other offers and you're just saying no because you don't want to sell at the price that's above what you're asking. Like, there's got to be some sort of, I don't know, any realtors that knows the answer to that, just because I've never seen this situation before. I'm just curious if they don't get an offer that's higher than what they owe on it. For example, let's say they owe 1.1 on it. Like, they can't, what are they going to do? Either take the loss and come up with a few $100,000, or like, what if the 500,000 is the highest offer they get? Do they have to take that? Are they like obligated to take the highest offer at that point?
I'll have to look into that. I don't know.
Yeah,
that is interesting.
interesting.
Huh.
Up for debate.
All right. It's co-host outreach.
Yeah, so we have been doing, our last episode that we did was, I shouldn't say our last episode, the last one that dropped, but a couple episodes ago, we did an episode on co-hosting and how we do that and how we kind of get our leads and run our co-hosting business for midterm rentals. And I've been doing outreach in our market with local realtors. We're actually going to be going on a podcast pretty soon with one, and we just reaching out to other realtors that we know and we work with and have a relationship with, just offering our services as a resource. Like, hey, if you have investors that you guys have that are clients and don't know about the midterm model and want to learn more, or realtors in your office and you guys want to know more about this to be able to educate your buyers if they are looking to buy rental properties, like, we're happy to come in and do like an education series and teach everybody what we know and what we do, because we know the local market pretty well. So we have a lot of expertise in our local market, but just kind of getting the word out there, and in turn, hopefully that will help us get some co-host leads on people that need a co-host. Hopefully, if they are looking for someone to help them out with that, we would be in consideration. But just trying to educate our local market on that.
Yes. I'm really liking the co-hosting. I'm excited to grow that.
Yeah, so we are actually contracting right now. We are realizing that for us, it makes a lot more sense to stay local.
Yeah.
In our local market. So that's what we know the best. That's where most of our leads are. That's where we are. So we're not having to drive all over Orange County. So we are actually kind of contracting and looking to like refer out some of our stuff that's a little farther away and just not taking on more properties that are farther away. So we're just focusing on our core market right
I
now.
think we've found what works really well in terms of a house size, a bedroom count wise with at least our network. And I think that just focusing on those houses is going to be the most beneficial right now.
Yeah, and
Make
I
the
think
most
that
sense
makes
for
the
the
most
business.
sense to really get really good at our market and what we know best. Maybe we will branch back out later on, maybe once we have a bigger team in place to be able to handle that. But right now, we're just trying to focus on making things a little more manageable and get really good at the micro of the business.
Yeah.
Yeah. Just a quick disclaimer. The information shared on this podcast is for informational purposes only and should not be considered as financial, tax, or legal advice. Always consult with a qualified professional before making any financial decisions. Your individual circumstances may differ and require specific strategies not discussed here. Now, let's get back to the show.
Excited about that.
Yeah.
What are we talking about today?
Well, so today we are talking about something that I've actually seen a lot online about, like on Reddit and articles and just forums, and people talking about how passive income is not passive income, or in the sense that a lot of passive, traditional passive income, real estate investing and things like that are not truly passive income. And, passive income is you're not doing anything. And I think there's a misconception about real estate. There's obviously different parts of real estate, but, I don't know. Why don't you tell me what you know about this now that you've been involved in it for the last few years?
I mean, I feel like if someone says that passive income is passive from day one, that they're lying to you or they've never done it. Don't you think?
Yeah, I would agree. If you're talking about real estate in terms of like buying a house, renovating it, renting it, holding it, and things like that, yeah, absolutely. There's really nothing passive about that.
Nothing, because before it's passive, it's stress, it's risk, it's, you're crunching numbers, like you're out of cash, you're late nights when everyone else is sleeping. Like it's not, no, it's just not that easy.
People even think like, oh, well, that's because you don't have a property manager, you're self-managing. Like we have properties that we've never even been to, we've never even seen, and we have property managers, and they still stress us out. There's still decisions we have to make. There's still, renovations that we've got to, figure out budgets on, and it's still not passive.
So is that not us not having the right property manager, do we think? Or, I mean, personally, I think no. I think that there's going to be decisions and things that happen regardless that we have to have, have our hands in. But then it's also finding the right property manager too, because we've had experience that we've talked about in the past of not having the right property manager. Like it's just there is no part of it that is passive.
Yeah, property management is only one part of it, though. You've also, like, the properties that we buy are value add properties. So, the apartment building we bought was a value add play. So we're looking to build equity. So there's a lot more that goes into a project like that. If we were buying, say, a brand new apartment building that just got completed and we're just looking for wealth preservation. So maybe later in life, and we're just looking to put money into an asset that just kind of maintains that and also builds over time, but maybe not as much, doesn't have the value add and the quick equity appreciation that we're pushing. Like we're not able to push appreciation on it because it's a brand new property. So in that case, you might be a little more passive, but you're still going to have things that happen. Even in the brand new buildings, you still have situations that arise that property manager's going to need you to get involved in. So no matter what, you're still going to have to make decisions. Now, unless you're just so far down the journey that you've got people in place to handle that, right? So you've got, asset managers that are handling all those decisions for you and nothing makes it up to you. Maybe when you get to that, maybe when you're a Grant Cardone, you don't have to deal with all those decisions. You're just flying around in your jet and talking. But
Well, do you think that that's like when you see it on Instagram, like the Instagram description of passive income, do you think it's people who have already made it that far? Or like, what do you think? Because you see that a lot, people talking about passive income on Instagram. Like, what do you?
So I think it's two things. One, I think it's a social media lie. I think you see a lot of like, oh, invested, passive income, this and that, and you don't have to do anything, and like buy our course. It's all these gurus, like, right, trying to get you excited about something that's passive. And I see all the ones that are always like, oh, buy Airbnbs, do the Airbnb, get a short-term rental, out of state short-term rental, and you're not even in state. Like there are going to be so many issues that arise. We're dealing with it right now. We've got on our midterm furnished rentals, and we have on-site managers, and it's still headaches still come to us. So that's just a lot of headache. Like the way that they paint that picture, and there's no amount of like, SOPs and like all your processes and people that you have in place that's going to manage all of that for you. That's going to come back to you where there's decisions that you have to make and you have to get involved. And I just think that that's a really like fairy tale picture that's not real in real life.
I agree. And again, this is related to real estate, obviously. So maybe there are other industries that are truly passive.
Well, real estate has a lot of different ways of investing in it, right? So if you're talking about owning the properties, there's really not a lot of passive ways to do that. Now, if you're a lender, you can come in as a lender, kind of like what we were talking about earlier, selling a portion of our equity. That investor that comes in and buys that equity, that is very passive because they have nothing to do with operations. They have no responsibility on expenses on the property. They are just buying part of the equity. They're just letting it sit and letting it do its thing, letting us operate it and stabilize the asset, move forward through time and allow it to appreciate. And that is a truly passive investment. Now, you could say, well, you could, end up in a situation where something happens and that person has to foreclose on the property or something like that. So and I've heard that argument. So in that sense, it's no longer passive. So you do have that side of things where, it could become where it's not passive, but it's still, if you're on the lending side, for the most part, you're going to be in a passive play, but you're not getting your hands dirty. You're not doing any operations, so there is that side of real estate that is more passive. And, another option is, and I don't know if we've ever talked about this. I've done this before, but investing in tax liens. So at the end of the year, like Arizona's one where everybody is late on their property taxes, they will, instead of the state carrying it or instead of the county carrying those delinquent taxes, they sell that to investors for up to 16%. They let investors bid on it. So it starts at 16% and then it gets bid down by investors and the lowest bid wins. But the property owners are paying 16%. So when they finally pay their taxes, it's already been paid. The county's already collected their money. So they weren't floating it. It was the investors floating it. And then they get the interest that was on that. But that's a pretty solid passive investment because you're going to get your money one way or another. Now, there's always the but. If they don't pay for 5 years, do you then have the option to foreclose on their property? At that point, it's no longer passive because you have to go put a notice on their door and you have to go through all the steps to be able to take possession of the property. And there's some legal stuff. You probably have to go to court. So at that point, it's no longer passive, but you're getting a property that you bought for $600 or whatever. So, really, there's not a lot of real passive investments, unless it's just something that's, I guess, with real estate, it always has the potential to not be passive.
Yeah. I think we did do not a full episode on that, but we definitely touched on that specific topic
The
here.
tax liens.
The tax liens. I will have to find in the show notes and add that in. And you kind of answered like what I was going to go into next. It's just like the reality of passive income and what that looks like. But kind of, at least in our situation I think it's also so different having a family. We talk about that a lot too. Like this would be so much easier building it just the two of us, but having a family adds a whole nother level. Like what's the reality of that?
We do this a little differently because we are moving into a lot of these properties and buying them as our primary. So it's a lot more moving parts and I would say way less passive. But even if you're just doing flips or you're buying properties and you're not living in them, and you've got a family, there's still a lot of work. Even if you're hiring contractors to do everything, you're still having to go and manage the project and check on it. So it's still taking you away from family time. It's still pulling you away no matter what. So if you're managing a project and the stress of these projects, we know flippers that have been just stressed out on projects that they did, and the carrying costs are huge, and then the market turned and it's not selling and it's sitting on the market and they're stressed out because they're making payments each month on these large construction loans.
We're not flippers, but we're feeling the stress of that. So
right, but I think that we feel that a little less once the property's done because we start renting it right away and we're renting it to cover the costs. Our properties cover themselves. Our properties cash flow. And the extra cash flow is what's carrying us through right now.
Yeah.
So, because of the way that we do it, yes, we have high carrying costs and we're paying way more interest than we should be right now, which is why we're trying to stabilize. But but the property, the assets themselves are still covering that. So once we get that stabilized, get that into a better loan, they'll cash flow even better. So the properties themselves, we're not having to continually come up with this money each month. So
And
that's
like
a
you
little
said,
different.
building those reserves so we don't have that stress of, thankfully we've been very lucky and have not had any months where we've had vacancies and had to worry about it. But that's always, we want to be smart and prepared for that. And so having those reserves built up is something we would like to be getting to.
Yeah, no, absolutely. So it's definitely a financial stress factor that comes into play with these properties. So, like we've talked about before, we are asset rich or house rich and just cash broke, like just the cash flow. Um, but everything's covering itself right now, and it continues to appreciate. And like we've said last year, our wealth increased even with the struggles that we faced. So that's a testament to the what we're doing that works, but we just got to get the cash flow a little more stabilized and make things a little easier.
Yeah, that would be nice. Get to a point where the cash flow is flowing.
Agreed.
It is easier. That's the goal, right?
Yeah, and I think also like you see a lot of the HGTV shows and like kind of glorifying the flipping, and they show some of the bad stuff, but they really make it look a lot easier than it actually is. Those shows that there's a 40-minute show or 30-minute show or whatever. That's a lot of those take, like we've figured, like some of those take over a year. Like they don't show you all the stop and go and waiting on inspections, and the carrying costs that they're having to pay on the interest for that whole time starts to add up really fast. So that's something I think a lot of people don't realize in these flip situations is these aren't just cash investors that have cash. I mean, maybe some people, but very few of them. The majority of people doing these, even the ones on the shows, they're not. It's not their own money in this. These are loans that they have on these properties, and they're making monthly payments that are high interest loans. So the longer it takes to get something flipped and sold, the less you make because it starts eating up your profit.
I think a couple of them do kind of touch on that, and they're more open about the length of time, obviously. But yeah, I agree that a lot of them are just very much glorified and just showing the renovation portion of it is what they focus on more, I think,
Yeah,
than the
definitely.
actual financial side of it.
Yeah, and I think just no one talks about like the emotional stress side of it.
Oh, I could talk a lot about the emotional side of it. How much time do we have?
We do. That's why we started this podcast, right?
Yeah, it's
Everyone always talks about, oh, I bought this house for this and put this into it and sold it for this. But everybody that has that exit, it feels great and they get out of it. But how many people have we talked to on our shows already that have done some sort of flip that they were really stressing out about? Like, look at our first guest, Nick and Aja. Like Nick, the first that large deal that he did, where he it was I can't remember, it was a commercial building they sold to a school, and he double closed it as a wholesale. But in between, he was like really stressing out because he was on the hook for a lot of money. And so like the stress of that deal not going through, it would have been detrimental. And then, Luke had another one where there was it was a big development that he was selling to an investor client of his, and they ended up backing out for whatever reason. And he saw the value in there and wanted to take on the deal and said, "Hey, I'll take it over. I'll take the deal." And, he ended up walking away with like, I think $470,000 on that one deal. But he had a lot of sleepless nights and just trying to get that across the finish line. He talks about coming home and just trying to be present for his family while he's got this in the back of his mind. Like, I'm about to lose a lot of money if this deal doesn't close. So just the emotional stress of some of these deals can be very, very heavy.
I could not agree more with you. I think, it's kinda like giving birth. I think in the stay with me for a second while I explain this, because the moment like, while you're in the moment of that, of having the baby, even, like, leading up to having a baby, it's so much on your body and, like, usually people give birth and, like, "I never wanna do that again." Then a few months later, you're like, "I can't wait to have another baby." Like, you forget it. You forget that part, and that's why you have another baby is your body puts up, like, stress blockers. That's not the technical term, but I mean, that is true. Your body makes you forget what you just went through so that you can do it again.
So are you saying that when you get that payday or you stabilize the asset, it's such a relief that your body or your mind blocks out the stress that
That
you
is
went through?
exactly what I'm saying.
Interesting. Probably true.
Yeah, I think it is.
I think if you get that payday, but if you don't, then you probably are never going to want to do it again, or it would be really hard to get back into it and want to do another deal.
Okay, true. I do agree with that. Yeah, I think if you get burned or lose a lot, then you're probably that's ingrained in you for sure. I mean, yeah, I think so.
Okay, yeah. So I think like when it comes down to it, some of the things that people don't talk about are like costs. Like one, we talked about the carrying costs. People don't think about, oh, I paid, $500,000 for this property, but they don't talk about it's costing me $1,500 a month in carrying costs. And the longer you go, the more expensive that gets. And so that starts to eat your profit up. And it's one of the like unspoken things, or like you say, one of the unsexy things about real estate investing is just that additional cost that starts to accrue. Things go wrong, things happen.
I was
Yeah.
gonna say it. I think the unsexy things for me would be like the unexpected costs that come up, right? Like you have a plan, you have a budget, you're being conservative with that budget, you're allowing room for things and errors and things to come up, but you have something massive come up and you're not prepared for that.
Yeah, we had that happen on our last project. We had two things actually happen. One, we got down, we were doing the bathroom where we took one bathroom and basically turned it into about 1.5, did like a powder room. But when we dug out, we had to break through the concrete, dig out about 4 feet down to reroute all the sewer lines. And the original sewer line that we had camera scoped before buying the property and said that it was fine, collapsed. Like once that dirt was pulled up, the whole thing just collapsed. So then that was a $15,000 expense that we were not expecting because now we had to replace the whole sewer line. We ended up doing a liner, which was cheaper than doing a full replace, but still that was just not something we were expecting. Then we got everything put back together. The house baseboards had just been painted, interior just finished painting, and that sewer line that we just paid for backed up.
Yeah.
And flooded the whole house and with sewer water. And we had to start all over. We had to tear out 2 feet of drywall in half of the house and flooring and start. We were so close to being done and we had to start all over.
Yeah. That
And that put us back. That put us back probably a good 4 or 5 months.
that put us back time, that put us back financially,
Money, yeah.
that put us back a lot. Emotionally again, like moving. Yeah, that was not a fun time.
Yeah, we were definitely in the trenches at that point.
Like truly in the trenches. I actually have a picture of the kids. Like it all. Like, yeah. Ugh. I also think too, it kind of comes back to you always hear people say like I'm house poor, right? Like you're house rich, but you're cash poor, which I like to say like cash broke. Don't you think?
It's the name of the show.
Truly is.
Can't hit the nail on the head any harder than that. Let me ask you this. Why do you think that what we're doing like feels so lonely at times?
Because we don't know anyone. Well, okay, a couple things. I think one, it's not something that people talk about often if they're in like a financial situation like this where they are so strapped. And I think we don't know anyone that's doing exactly what we're doing or even like close enough to it. No one that we're like really close with. I think as we've had this show and as we're networking more and getting to know more people, I think we're starting to meet people not necessarily in the same industry, but doing other things that are in a similar situation, which is helping. But it can feel lonely when you can't do things with your friends and your friends don't understand because you're cash broke. Right?
Yeah, no, absolutely. I mean, it's something that, I know you struggle with maybe more than I do at times. I tend to stay a little more positive, whether I'm actually feeling that way or not. I got to portray that, but it's definitely not easy. And I mean, it's worth it in the end, but when you're going through it, it really makes you question, is this really worth it? Like, even if we weren't living in these houses and we were just doing it as an investment, like it's still There's a lot of financial risk. There's a lot of time that goes into it. When we get it done and we get it pictured, I feel like that's that relief moment. And it starts renting. It's like, it's working. It's working. Like it was all worth it. And now we have this asset that we just almost doubled the price of. And we have something that people want to live in. And so there's a lot of demand for that asset. I think that kind of makes, like you said earlier, it kind of blocks all the stress out and makes you kind of forget about it.
I think so. But I think that it still doesn't make the day-to-day easier necessarily. I mean, there's still like big things we've missed. Like when we talk about the sacrifice, you know, that's the part that I think gets really hard. That I think that's why it can be lonely, is people don't understand why we would put ourselves in this situation, in a sense, why we would choose to make these sacrifices. Why would we make things so difficult and like struggle each month to get by and miss family weddings and very close friends' weddings? Like,
yeah, but that has nothing to do with the real estate. I would argue that it doesn't have anything to do with like our personal financial situation. Doesn't actually have anything to do with the real estate. That's a completely separate business. Like income that has nothing to do with it. We actually, because of the real estate, we actually have a little bit of income, so that's actually helped us. But that doesn't really have anything to do, I would say, with what we're going through on the financial side.
yeah, that's true.
And there's additional costs too that people don't think about. Just we self-manage our local properties, so that's time. Almost every day we're doing something or going somewhere to attend to a property. Like it takes time and there's cost to that.
Yeah, I mean, I would say, once we finished that last property, I was obviously so excited for you to be done with like the physical labor of that house because that was taking you away. But I would almost argue that there's still things with these local properties that even though you're physically at the house and like you're in your office, but you're still on calls, you're still doing, I would argue, almost as much as you were physically.
Yeah, it's just not physically like in digging the trenches or swinging a hammer. But yeah, it's still definitely a lot of work. So there's definitely that to consider. And then also, an additional cost that because we do midterm rentals, one, it cash flows these properties and makes them a lot, more profitable and actually makes them make sense and pencil better. But one of the things that people don't think about or that we have to like factor in additionally on top of the renovation budget is furnishings. We had to get the last one because we used all of our cash on trying to get that across the finish line. We had to take out a private loan just to get all the furnishings completed. And I want to say it was like $30,000 to $40,000 to furnish it. So it's just one more expense, and you don't make that money back that quickly.
No.
Maybe over a couple of years it makes sense, but overall the asset, it makes sense, but it's not like you're getting that money right back right away because you've got a mortgage payment that you're paying. So,
and like we've talked about we've talked about how we furnish these homes. Like we are not going out buying expensive pieces. We try to make it look as high end as possible, as budget friendly as possible. But that was, it was a 5-bedroom house, so it's a good size house. It was a lot to furnish, and it adds up quick.
Yeah, and then I would say just the cost of all the mistakes that we've learned along the way. Those are expensive. Some of them are very expensive mistakes.
Which one would you say is your favorite mistake?
Let's not go into the favorite mistake. That's a whole nother episode.
Okay.
But yeah, and going back to the passive, I would just say like, even once the property is completed and we're renting it, if your phone is still ringing because of the asset, it's not really passive. We constantly got calls from guests and since we're self-managing too, what we do, I would say, is definitely not like I would never tell anybody that our strategy with real estate is passive because there's really nothing passive about it. The phone's constantly ringing for one property or another, for whether it's an issue or just a placement with a placement provider or whatever it is. So the phone is always ringing.
So do you think we personally will ever be at a point where we have truly passive income with what we're doing?
No, not from the asset, but I think we'll be able to have people in place that are answering that phone, so we're not having to do that. So for us, it may feel more passive, but the actual asset or the strategy itself is not as passive because you're having to pay somebody now to manage it. But I think we'll get to that point where we've got a team that kind of handles everything for us, but you still have a team you're paying to manage it. So it's not, at that point, it's not passive.
And you're managing the team, which is still another layer to that as well.
Yeah, that's true. Let me ask you this. With the deals that we've done since we've been married, which one is the one that stressed you out the most?
Wow. um, I think that, gosh, that's hard. I think the first one, in the sense of just not knowing what to expect and having our first baby and like not kind of building up that like tough skin, I think that had a lot of stressful moments. Living in the construction site with babies, I think that was hard.
Well, and that was your first experience doing this. So I'd
Yeah.
kind of gone through it a little bit, but that at that point, that was probably my most extensive renovation all at once because we were trying to get as much done as we could before we moved in. And we had a young baby, so we didn't want like the dust. So we got a lot of the heavy lifting stuff done first, just demo. And you remember that there was brick. The entire downstairs was just brick. Like it was not brick looking tile. It was actual brick that these people had. They loved brick so much that they had it as the floor.
Yes.
It was insane. It was 2-inch brick on the floor.
Yes. We'll have to like put a video or a picture of it somehow because it's unreal how much brick was in this house.
So that, we brought in the demo crew and jackhammered the whole downstairs, so living room, kitchen. There's just like we have pictures where it's just like giant, brick, like sections of brick just all broke up. And I remember walking in there when they weren't working and I had to go do something. And I walked in there and I just looked around and I was like, I had like that kind of freak out moment. I was like, what did we get ourselves into? Like, we're supposed to move in here in 3 weeks and it's literally a pile of rubble. It looks like a junkyard. And it was a little overwhelming, but we pushed through. We got moved in when we were supposed to move in, and it was not complete, but it was complete-ish, or it was livable in the sense of like we weren't walking on brick and dirt. Like we had flooring in, we had working bathrooms, did not have a working kitchen.
No, we were doing dishes in the bathroom sink. We were
Or Uber eating a lot at that point in time.
I don't know. That's a really hard question because I feel like you said, like that was hard because we hadn't done it before. But then the next one, we had a lot more kids and I was pregnant through a lot of it.
Well,
And
if you remember when we moved into that one, it also was not finished. It was more finished than the other one in terms of like the overall project. It was a much bigger project, but some of the finishing stuff wasn't done. For example, we didn't have a kitchen. Again, it always seems to be the last thing. So we didn't have a kitchen and we had working toilets, but we did not have a working shower or bath.
oh my gosh. Yeah. Okay.
So you were taking the kids down to your parents' house to like bathe them a couple times a week because this was like a 2 or 3 week thing. And we had, we
We had a camping shower.
I ordered one of those from Amazon, like the bladder bag. I would fill it with, we didn't even have,
We had no hot water.
so to start with, the first week, this was only like the first weekend, I think, the water heater hadn't been put back in yet. And so we were waiting for the gas line to get signed off because we couldn't turn on the water heater until the gas line had been signed off by the inspector and it was okay to hook up. So I didn't know that. That was a lesson learned. I did not know that you couldn't hook the gas appliances up until you had sign off because they want to make sure that everything was put back together and there's nothing leaking, make sure all the pressure test was good. So we did not have, we had water, but we didn't have hot water. So I had to buy this bladder. And first thing in the morning, I would fill it up. I would go stick it outside. Luckily, it was summer. I would let it.
It did not do anything. It did not matter that it was
Oh, it
summer.
helped. That was real cold water. It helped. It would sit in the sun all day, and then we would hang it up on our back patio on the rafters at night and take the fastest showers with this little hose thing that we had that was dangling.
But do you
off of
remember the
us.
hose? You had to like get low because if you lifted the hose up to you, it would like kink it and knock them out. So the kids loved that though. They showered.
Oh yeah,
in
we
that.
had
It was like their car
cardboard.
wash.
We had like a little cardboard stall hanging from the ceiling out on this patio so that the neighbors couldn't get a free show. But yeah, it was interesting.
We also, do you remember? Okay, I think the thing that I was.
So when we say that we make sacrifices to build these houses, we were making sacrifices.
Like I come back to, nobody better ever tell us we are lucky. The other thing that really stressed me out about that house is there was no railing on the stairs. You had to makeshift the railing. The stairs were just plywood, remember?
Yeah.
And we had to like makeshift a railing for a very long time. That was like that till we almost moved out. Um, so what was your hardest scenario house? Question going back to you. Which one do you think was the hardest?
That's a good question. I think probably the second one, not because of the house so much, but more because we had a larger family. And so trying to create a comfortable living environment for you and the kids was, I know, emotionally draining on you. And then me just trying to get everything across the finish line so we could have, pushing the tile contractors, so like get the tub. I'm like, we just need a tub. I don't care about the shower, get the tub done. We got to we got to bathe the kids. Like, just get the tub done.
Well, it's one thing chasing around one kid in a house that is, like, dangerous and, like, not set up well and containing them and containing the mess, but when you have 3, that's a whole other you have a baby that's learning to crawl, yeah, trying to keep eyes on and keep safe 3 kids in a house like that is a lot more work.
Yeah. So coming back to the passive income, again, what we do is not really passive, but I also think that, you know, passive income is not something that you buy into. I think it's something that you build into. And what I mean by that is, you're not going to just invest into even a business, invest into a business or real estate or some sort of asset that you're buying and have it be passive. It's the systems that you put in place that make it passive. So like we're building up our co-hosting, like we're going to have a team, we're building up our systems right now, all of our standard operating procedures and kind of building out what that looks like so that we can hand that off to somebody else to be able to manage everything. And then for us, even though we still have to make decisions, the day-to-day, the phone ringing, it starts to become more passive as we step back and have those systems in place for somebody else to be able to take the reins and run with it. And I think it's the same thing with real estate. You can get your systems in place to run more efficiently and to automate with AI. You can automate a lot of things these days. Our screening process is all automated now. Somebody books on Airbnb and all of our systems kick in and does all the screening and does the lease, and all this stuff is automated. So we're not having to go back and forth with it. So there's a lot of systems that you can put in place to make it feel more passive and take up less time.
Yeah.
I don't want to scare people away from this stuff, but we also want to talk about the ugly truth of real estate investing and, owning a business and just anything that, there may be a misconception out there that it's passive when it's really not that passive.
I was gonna say, do you have any advice for someone who's wanting to be at that point where they have passive income?
Well, I think if you really want to be passive, you got to get to the point where you're not taking risk. You're investing in gold, silver, bonds. Those are true passive investments that don't require anything, but the returns aren't there. So, we're at our point in our wealth building journey where we're building and we're not just trying to preserve our wealth. So I think while you're building, you're really not going to be in that full passive investing. It doesn't matter if you're doing stocks, like you can do trading options, which I've done. And we actually have somebody coming on soon to talk more about that, which is another interesting strategy. But it's not passive. Again, you're still having to make trades. You're having to pay attention to things. Like there's just not really anything that's passive until you just put your money and set it. You buy into a company, a stock, and you just set it and forget it. And your gains are going to, maybe you get lucky. Obviously there's people who have put money into, Bitcoin and forgot they had it. And then 10 years later, they've got multi-million dollars and it's sitting there in Bitcoin, just as a fluke thing. So yeah, it can happen, but it's not something that everybody can replicate. Like you get lucky here and there, but I think that just knowing that while you're building, you're going to be more passive and work on building. And then as you get older, closer to retirement, or closer to just wanting a stress-free life, at that point, you move it into those more passive investments and just, it's more about wealth preservation at that point.
I agree. I feel like if you're in the messy middle, you're not really doing it wrong. You're just early.
Yeah. Yeah. Because it's like a stage thing. So, as you stabilize assets, your business, you get people and systems in place, it becomes more passive. But at the beginning, you start a business, there's nothing passive about starting a business. You're up late, you're working long hours, like you're trying to get that thing off the ground. And so it's very far from passive, but it can become way more passive as you grow it and as you get further down your journey on that business. So yeah, so just early on, you're not going to have that passive feeling, but you can definitely get there with systems and people to be able to make it more passive for you.
Yeah,
Yeah, I
absolutely.
agree with that. It's good.
All right. Anything else on?
No, that's pretty good. I think we haven't really touched on that, and I know that that's a real hot topic these days. Is it truly passive? Is it not? So I think, just again, passive income is going to be, stocks, gold, Bitcoin, if you're just leaving it, forgetting it, something that doesn't actually require you to do anything, but you're not going to have those returns and build. I mean, I shouldn't say you're not going to, because you could get lucky, but
It's more of a luck versus a sweat equity.
yeah, at that point, yeah, I would agree with that. But the same. There's a lot of risk too. You can also lose a lot of money in those scenarios.
Very
so
true.
if you're doing maybe gold or like bonds, like that are super safe, that's a real good wealth preservation type passive income.
Yeah.
So don't get all hung up on those social media reels that say buy 20 Airbnbs and it's passive income out of state and you don't have to do anything. Like, you're going to have some restless nights and you're going to have some decisions to make and you're going to have some losses that you've got to figure out. So
Absolutely.
yeah.
Have you been reading any books lately? We've been up and not sleeping much with two of our children, so I don't know if you've had time to read, but
I finished The Wealthy Way by Ryan Pineda, and that was actually really good. I really liked that. Love to get him on the show.
oh my gosh, that would be amazing.
He was a couch flipper. He was an OG couch flipper around the same time that we were. So I'd love to get him on the show and talk about couch flipping one of these days.
I would love to know. Yes, I want to hear his story about the couch flipping, because like you said, it was around the same time you guys were doing it, right?
Yeah. So
just hear the differences, and yeah, that'd be cool.
I just started reading another book called The Lords of Easy Money. It's about the Federal Reserve and the 2008 crash and how they were navigating that and trying to curb inflation or prevent inflation, but get us out of the mess that we were in. So just started that book, but we'll see where that goes. Just learning about I would say, behind the scenes of money in the U.S. and how the Federal Reserve controls everything.
Yeah.
Yeah.
Love it.
All right. That's it for today. Anything else? Last words?
No.
Okay. Like and subscribe. We're doing YouTube now consistently. So if you prefer to watch on YouTube, check us out. We've also got a lot of short reels, and we're doing some other informational videos on there as well. So we've got quite a few videos that we're putting out there and building an audience there as well. As always, leave a review if you have a few seconds.
A rating at least.
But if you don't have a few seconds, leave a rating, because it literally takes half a second. You just tap that 5-star and that's all you got to do. We also have our community that we're launching. If you're interested in that, you can check that out. We do have a website that just went live that's got some information on that, and you can book a call in there with us to learn more about that. It is BM for Broke Millionaires, so bmlegacywealthbuilder.com. And we're also going to be doing probably some webinars coming up. So we'll do some master classes on some of the stuff that we talk about, some of our strategies. So we'll be putting those out and letting everybody know about that. And also, we are launching our newsletter. We probably should have done this a long time ago, but we are going to be doing a newsletter. We'll put that in the show notes, but you will be a link where you can sign up. But just keeping you up to date on our episodes and our guests and just other strategies and, creative tax, things that come up, because that's always changing especially with, I feel like, Trump in office. It's like every week there's something he's trying to do, or
every week,
whether it's for taxes or with real estate. So there's all kinds of stuff that's changing all the time, but we'll be sending out the newsletter. So if you want to sign up for that and stay in touch that way, you can do that. And that's pretty much it. All right, get out there and make it happen.
Thanks for listening. This has been a production of Rebuilding the Dream Studios.